I know a lot of people are interested in getting into apartments, and not many people know really how to underwrite, how to make sure that you're going after the right opportunity. And it's something that you really have to know what you're doing, like I mentioned a couple of minutes ago. And so definitely want to come in to talk about due diligence, but then also kind of go through the process of how you should go about doing the due diligence. And towards the end, I'm going to show, there's a checklist that I have actually on my website that, you know, anyone can download for free to really know exactly what documents you need to have. And there's one thing to have the actual list of things that you need to have, right? But what do you actually do with that list? So I'm going to go through it kind of like a step-by-step, week-by-week process for the due diligence process, which is usually about, 30 days, right? Especially in a hot market. Typically a due diligence period is 30 days followed by a closing period of 45 to 60 days, depending on the lender that you choose. So let's go ahead and get started. So, all right. So a little bit about me. My name is Cudjoe-Virgil. Company is called Merlin Acquisitions. Our primary market is Baltimore City, focus on value-add multifamily. Done a couple of deals, couple of syndications throughout the Baltimore City market. And right now our focus is still value-add opportunities, and we're pivoting into commercial real estate, traditional, more retail, maybe industrial. Really our game plan is cash flow. And so definitely, again, I'm excited to talk to you guys today, and we're going to jump into topic of due diligence. All right, so due diligence, it's a lot of work, honestly. When people are getting into the commercial space, they don't really understand the amount of work that's required, specifically when you are doing a value add project. It's one thing to buy, stabilize, let's say a 50-unit building that's already operating and performing, but it's a lot of work when you're trying to take a property that is, in distress mode and turn it into something that's profitable and stabilized. And so the due diligence process is a crucial point to determine the financial feasibility, or actually just to determine to move forward, right? The key in due diligence, honestly, is when you're underwriting and you're looking at opportunities and you have something on the contract, you want to spend the least amount of money possible, because this is, as some of you guys are already real estate investors, you guys know risk capital is something that you don't get back, right? So we're going to talk about what you need to focus on, how to spend the least amount of money possible. But in this specific stage, you want to get as much information as possible to make the best decision for you and also your investors, right? Because it's one thing to do something with your own money, but it's another thing that you need to do with investors' money, right? So it can be frustrating, right? It can be a lot of work, but my goal today is to really create a plan using the checklist that I'm going to talk about towards the end. You can use this to create a plan, so when you do have something on a contract, you know exactly how to go about it. So this is my my goal for our quick 20 to 30-minute discussion today. So you have to have a plan, right? Prepare for your due diligence execution plan. And it's all about it. Obviously, in real estate, you have to have a plan whenever you're doing something, right? If you fail to plan, you prepare to fail. And so it's no different when you jump into the commercial real estate space, and we're going to dive into some due diligence aspect. So there are typically two phases, right? There's the financial phase and the physical phase. Now, the financials is everything that's related to the financial aspect of the property and the business plan. So that's analyzing the income, the P&Ls, the bank statements, everything that has to do with the finances, the finances on the property. And this is probably one of the most important parts, because as you guys may already know, commercial real estate is valued based off of a multiple of income. So every time that my NOI is increased, that means the property is worth more. If it decreases, it's worth less. So if you're not really strong on like where the finances are in the property, you can get into a situation where you probably are going to be in a world of hurt, and your investors will too. So there's the financial aspect, and then there's the physical aspect. So the physical is everything to do with the physical aspect of the property, including deferred maintenance and capital improvements. So think of the physical, right, similar to like, a health physical, right? You want to go in and check and make sure that everything is up to code. You have all of the things that you need to have within the property to make sure that it's operating correctly, no deferred maintenance. And so in this phase, obviously, is where you start to spend money, right, on inspections and this, that, and the third. And you want to focus on the financial aspect up front to make sure that you're not wasting money on the back end. So when we talk about due diligence, right, you typically have 4 weeks to get everything done. And what you want to do is try to compartmentalize your time as much as possible, because a lot of times that time can go really quickly, right? And so if you're doing this all by yourself, definitely have to have a plan, because if you miss something, then it's going to be on you, right? As opposed to having a partnership, right? You start to delegate different tasks. You know, this person is responsible for looking at this, that person is responsible for looking at that. And when you do that, now you get to spread your time and really focus on what you need to focus on to make sure that you guys are buying the right property. So in this particular stage, whenever that you're under contract and you're starting the due diligence process, never start your due diligence process until all of the documents are received from the seller. Our attorney has this in all of the contracts that we've written for properties that we own. You know, our due diligence, that 30 days does not start until we get all documents from the seller. Now, there's going to be a case-by-case basis where, you know, the seller might be missing like a water bill or something like that, right? And that's something that we're not really going to worry too much about. We can probably get that. But if it's something like financials, you know, historicals on the property, that's something that we need to have before we start due diligence, because that time is ticking. And a lot of times brokers want to close as quickly as possible, just like sellers, right? And they're going to try to move you in a way that you know wants to push you in a situation where your clock has started, right? And so what you want to do is never start your due diligence until all documents within that specific checklist, which I'm going to talk about towards the end, is received from the seller. Really important there. So within that first week, let's talk about things that you really want to focus on within the financial side, right? One of the things is doing a lease audit. So basically what this is you take the existing rent roll of what the seller gives you, let's say a 50-unit property. Everything that the seller gives you within that particular rent roll, you want to match that up by lease for each tenant in the property. And why that is important is because you want to make sure that the income that the seller is stating is what you're actually going to get. There are many times where, you know, you get into mom and pop situations, and I'll talk about that in a little bit, where the seller has one thing, but the rent is actually lower on the lease, right? Little administrative things like that, you really want to pick apart and also understand exactly like what's in the lease too, right? Because if you're trying to vacate, let's say 3 tenants in a 10-unit, for example, right? Or just let's say like a half of the tenants over 2 years in a 50-unit building, right? If it's in their lease where they have things like automatic renewals, you definitely want to know exactly when that is and how that affects your business plan to actually vacate those units. Because if you can't, that obviously impacts your ability to turn those units around and get the returns that you want for your investors. So definitely a lease audit. Looking at the current rent roll versus historical rent rolls. The reason that you want to do this is because you want to see where income is trending within the property. If the rent roll is the same from January 2022 to December 2022, you're probably looking at that and saying, well, my income is stagnant, right? I don't know what's going on. Let me investigate. Versus if the income is different in January 2022, it's lower compared to December 2022, then you can probably gauge and say, hey, well, this property, the income is trending positively. All of the things that you really want to have in your thought process when you're evaluating the financial feasibility. Verified bank statements. I can't stress this enough. So this is something that's really important. Like a lot of people try to talk about the mom and pop space, right? Try to find something off market or mom and pop deals, those where the deals are located. Yeah, that might be true in some cases, but a lot of times with these mom and pop operators is that they don't have solid financials. And what we've done in the past when we ran into this is we actually had to prepare somewhat of a P&L based off of paper financials that the seller gave us. And so another thing too is I don't really like to trust like spreadsheet financials as well. And I might be getting ahead of myself, but the reason that I don't like to trust spreadsheet financials is because anybody could do anything with a spreadsheet, right? How many times can people financially engineer a spreadsheet to make numbers look good, right? So a lot of times, if it only has a spreadsheet, my ears are up and wide open, right? And my eyes are wide open, because that tells me that he potentially probably could manipulate the spreadsheet, versus if I'm buying from, a more established private equity firm or an institutional firm that has systems like maybe an Appfolio, which is a property management system, or a Buildium, or a Rent Manager, or something like that, right? That actually you have to go into a system and actually input the rents and the collections and things of that nature. It's way more challenging to like manipulate that information versus doing it on a spreadsheet. So definitely verify those bank statements, because when a seller gives you a P&L, you want to match up the rents that are actually collected per month versus what's actually in the bank. Because again, if you get into a situation where you close on a property and you're not getting the income that you thought that you would, your investors are going to be pretty upset. So trailing 12, next one is trailing 12 P&L versus historical P&Ls. This is similar to the current rent roll versus historical rent roll. Is just taking a look at how that property is operating over time. Because what your lender is going to do is your lender is going to look at trailing 12 expenses to underwrite the property, and they're going to look at probably T3 income. So T3 income is basically the trailing 3 months of income on the property, and try to maybe analyze that number to figure out, hey, is this property going to be performing well over time? Is the income going down? So you really want to figure out, like, what does that look like from a P&L basis to make sure that you know what you're getting into on the property. So the operating expenses, right? Similar to the P&L, definitely looking at what's in the operating expenses. Am I seeing a lot of plumbing issues, like plumbing costs, electrical costs, some of those big ticket items that can cause concern when you're looking at a property. So you definitely want to know exactly how the property is operating, because a lot of times those expenses could be little cues on, physical issues on the property. Then after that, after you do your full financial due diligence, you reevaluate the deal, right? Because as real estate investors, we're always just fine tuning that underwriting and figuring out exactly like, how is my deal going to pencil? And I mentioned, commercial real estate is based off of income, and you have to know exactly where your income is coming from and how your expenses are actually going to pan out. All right, so week 1, you're done with the financial due diligence, right? So the next step is that should be physical due diligence. Sorry. So the next step is physical due diligence, right? Ignore the financial part. Physical due diligence, right? Get your inspection dates set as quickly as possible. A lot of times you can kind of get caught up in the first week because it's a lot of information. Like I mentioned, let's say you're doing a 100 unit property. That is 100 leases that you have to go through. And that takes, that takes time, right? Some people might have W-2 jobs and might be busy doing other things, but somebody's got to go through all of those leases. So, when you're coming into the second week, have those inspection dates set up front, because you want to make sure that you have an opportunity for your inspectors to go in. And if you're getting into a larger property, make sure that the inspection company has multiple inspectors that they can send on site, because the last thing that you want to do is rush an inspection, specifically when you're looking at larger unit counts. Like, I always like to have at least 2 to 3 people at least going into different units, because you don't want to get into a situation where it's like that. How, and some of you guys are already real estate investors, right? You might buy a property that's already occupied, and you have this like awkward feeling going into somebody else's space, and you feel like you don't want to crowd them. But you want to make sure that you have multiple inspectors so they can just take their time going through units. So that's really, really important. The second thing is definitely clear responsibilities with your partners, right? Because the thing that you want to do is you want to try to delegate as much as possible. And I'm going to talk about some of the delegation things that you could do to make sure that you're getting all the information. But you don't want to have the same partners walking through the same units, right? You guys want to kind of spread out depending on what the numbers that how many numbers that you have inspecting the property, but definitely have clear responsibilities so that everybody knows exactly what they should be doing, what they should be looking for. And then when you guys are done the inspection day, you come back and have that group discussion, a group call, and really get a handle of the property. So definitely have a clear responsibility. The third thing is clear direction for contractors, right? Because if you're only really getting one day to do all your inspections, right? And let's say you need a plumber to come through. You need a plumber to come through and look at the sewer lines because you might have saw a bunch of sewer expenses in the P&L, right? You definitely want to make sure that your contractor knows who to talk to, because it's really frustrating when you're in a unit doing you're taking photos and this, that, and the third, and you got a contractor calling you and saying, hey, I'm outside, right? It's like, now I got to stop and do what I do to go talk to him, and now I'm losing time within the unit. So it'd be ideally if you can have a partner that's responsible for managing those contractors and telling them like where to go. That is something that you definitely want to have, because or else it's going to take out of your time if you're doing it. So definitely have clear directions on for your contractors. And then don't skip on the big ticket items, right? Definitely look at that HVAC, the sewer lines. One of the things that we love to do is we love to scope all of the sewer lines within the property, because that's one of the things that, as real estate investors, we don't get to see all the time. A lot of times, let's say in my market, specifically Baltimore City, right? A lot of the construction for the multifamily Class C affordable garden style apartments, those were built in like 1960s, 1950s, versus like maybe a Texas where you might see a lot of garden style apartments built in the 1990s, right? So the 1960s properties might have the cast iron. And so you definitely want to inspect those to make sure that you don't have any problems within the sewer lines. So like little things like that, the big ticket items, definitely don't skimp on those items. Know exactly what your lender wants to see in lender requirements. So your lender might do what's called like a PCA, a property condition assessment. And it's like 140, 150 page assessment that, Freddie Mac might want you to go through, because that's part of their loan guidelines, right? So knowing exactly like what your lender might be looking for as well, specifically might be within the inspections or the PCA report. So anything that your lender wants to do on a physical due diligence side, definitely know that and try to loop that into the inspection date if possible. Inspect for insurance issues. One of the things that can be complicated, let's say, for example, you might run into a property that has aluminum wiring. Well, a lot of insurance carriers don't like to take on properties with aluminum wiring because it takes on an additional risk. We bought a property that we thought had aluminum wiring. We found out that it actually didn't. But we had to get a specialty carrier to take on that policy because it had aluminum wiring. Or at least we thought it had aluminum wiring. And a lot of times with aluminum wiring, when it gets too hot, basically, you can cause a fire within your property. So little things like that, know exactly how that would affect your ability to get an insurance carrier on the project. All right, next step is leverage technology, right? We're living in a space where technology is among us. And I use something called Trello, Trello. It's like different cards that you can have to just kind of put information and have a nice area where you can store all of the information, right? Things like Google Drive, any sort of technology that you can collaborate with is super, super important. And take your time and eyes wide open, because there are a lot of things that are in the multifamily properties that you don't want to miss. And so ideally, what I like to do, as I mentioned, is ideally what you want to have is at least 2 people per unit walk in one unit, right? So you have one person that's taking notes, the other person taking photos, because if you're taking notes and photos, it's easy to kind of miss something, as opposed to if you're just taking notes, you're just focused on looking, talking to your partner and taking notes, where your partner is just taking those photos, he's not taking notes, or she's not taking notes, and she's looking and just taking photos, and you guys can kind of communicate. So it's like the little things like that a lot of people don't talk about is the thing that is going to separate you from doing an inspection versus actually investigating the property. All right, so week 3 to 4, right? You did the financial due diligence, you did the physical due diligence. Now it's time to validate all assumptions and information, right? And this is the part where you start to sharpen your pencil and really figure out exactly what is my project going to look like, right? You did the financial due diligence, you did the physical due diligence, you might have gotten the inspection reports back depending on how quickly the inspectors got it back to you. But now it's time to, validate all assumptions, right? So one of the things that we love to do is something called secret shop. And basically what that is if I'm buying a property, maybe next to another apartment building, I'm going to call that property, that other apartment building and ask them, hey, what are you guys renting at for a 2-bedroom, 1-bathroom units, right? How much are you guys charging? Because a lot of times on websites like apartments.com, they only list asking rents, and asking rents are different from effective rents, because the asking rent is just like what they're asking, right? No different from like what a seller is asking if they're selling a residential property, right? The actual effective rents is what they're getting on the property. So a lot of the times you don't really know like what they're getting, unless you know somebody that might live at the property. But you definitely want to know where your comps are compared to where you are, because if you're located in an area that has a good amount of competition, you probably don't want to be above the competition if you're offering the same thing that the next person is offering, right? So we like to secret shop those properties to make sure that to make sure that we know exactly what we're getting into. And then you want to review all of your third-party reports. So this is the inspections that I talked about, maybe your appraisal, all of your third-party, your environmental, your property condition assessment report, all of the reports that your lender is going to ask as well. You should be able to get this back within that time period. And if there are any issues, maybe negotiate directly with the seller or broker. The next thing is consult with your property manager. So property management is probably one of the most important parts of apartment investing, because you want to rely on your property manager to confirm your assumptions. So you did all the due diligence on the front end, the financials, the physicals. Now you want to take those potential rents that you think you might get, right, and confirm that with your property management company, because they're the ones that's actually in the marketplace, leasing different units that they might have in the area. And so they should have a good feel for what units should be rented at a specific rate, right? And so same with your expenses, right? They should know what a normal quote unquote property should operate under for a particular property of that size and with those amenities. The fourth thing is gather local municipality information. This is things like zoning. Like for example, we ran into a couple of properties where in Baltimore City, some of the units were below grade. And it just so happened that this particular property was in a floodplain, right? And so what the city was actually trying to do, what we found out, was take those units offline, because recently, because of global warming and things of that nature, there's been more flooding than it has in the past historically. So they were trying to take those units offline. And so we didn't know that. The seller didn't tell us that, but good thing that we knew, and we backed out of the deal. And little things like that is something that you definitely want to know about, because, I mean, if they would have took, for example, 10 units off of 30 units, that's a third of the property, right? And so that definitely impacts our ability to invest in that asset. Another thing is just the title reports, right? This is something simple. You're probably going to get this back anyway from your title company, but definitely take a look at those title reports to know exactly if there are any issues on the property, maybe an easement, for example, which is basically a right to something under your property. So maybe the utility company has an easement, little things like that you want to pay attention to. And then after you do all of that, reevaluate the deal, make sure that the deal makes sense, make sure that you know what you're getting into. And, if the deal doesn't work, do not move forward. I think we're living in a time right now where people are like trying to get the deal to work and make the deal happen and doing whatever they can to make the deal work. Because a lot of times, as you might know, as investors, when we spend money on something, it's easy to get emotionally attached. But in the world of commercial real estate, or just I think in business in general, you definitely don't want to get attached emotionally when you're making an investment, because every investment that I had some sort of emotional attachment to in some way, form of fashion, I got too wrapped in, to emotions. I regretted doing that deal. It wasn't something that I lost money or anything like that, but I look back and I was like, I probably shouldn't have done that deal. So here's the multifamily due diligence checklist that I mentioned. What I can do is I can put this in the chat here as well. And then we can also send this out to when we send out the recording as well. But definitely, as I mentioned today, the checklist is one thing, right? It's one thing to have a checklist to know how to know what to have. But the second thing is to actually know like what to do with it. So I want to open it up for like any questions. I took everyone off mute. And, if anyone has any question about anything regarding due diligence, would love to talk about anything due diligence on multifamily for the next 10 to 15 minutes, so we can really have a group discussion. And I hope that, you guys learned something today to go buy apartments.
Hi, it's India. How you doing?
Hey, India, how's it going?
I'm good. This was great. I had a quick question. I had to step away briefly to take a call, but you said something about clearing direction for contractors. I think I know what you were trying to say, but what was your, your rationale and reasoning, kind of the definition of that for you?
Yeah. So basically what I'm trying to say is, like, let's say you got 100-unit property, right? And you have one day to do the physical inspections, and you're trying to walk all of the units within the property. The reason is because you want to walk all of the units because you're going to put that in a spreadsheet when you put that on paper to really figure out exactly what your renovation budget is going to be. And so when you're busy like walking through all of the units, you don't want to have to, you personally may not want to answer the phone to a plumber that wants you to tell him like where to go, right? Or show him where to go, introduce him to a broker, right? Because that puts you out of your realm, which you're focusing on inspecting these units and taking the notes and making sure that you have everything you need to put your renovation budget together. So you might have somebody else on your team or within your circle or whatever the case may be that's responsible for showing all of the contractors or telling them what to do within that specific day. So it's kind of like a quarterbacking situation, right? You got to make sure that everybody knows where they're supposed to be, because a lot of times these brokers, they would try to rush you to do all of your inspections relatively quickly and just be done with it, right? But your goal is to make sure that you have all of the information so you can make the best decision to move forward. So when I talk about a clear direction, that's where I'm coming from, is make sure that your contractors know where to go instead of you scrambling to tell them where to go when you're focused on something else.
Okay.
So it's just a preparation and planning type of thing.
Gotcha. I just thought it was some like unique sort of thing that you do. So it's just kind of cut and dry.
Yeah.
So
It's just letting people know where they want to go, because it can be stressful at times.
Yeah, but I definitely like the
walking.
choice of words though.
Yeah. Sounds good. Do we have any other questions maybe about anything with the due diligence process? Anything regarding the physical inspections or the financials? The financials is something that's super, super important.
I know. Hello. Hey, Cudjoe, this is Avery.
Hey, what's going on?
Hey, so just had a question about. I know a lot of times throughout your examples, you were using like more so, the commercial, not commercial, but the bigger units, such as the hundreds. Um, would this apply for smaller units, such as like the fourplex and duplex types?
I don't think to the scale of those smaller units that a lot of these items would apply, because you don't have a lot of responsibilities in a 2 or 4 unit property. And so I think it's easier to manage that inspection process because it's not a lot that you have to actually go through, right? I think one person could probably handle that. But this is more so the larger acquisitions. And I think, within the smaller space, I think some of these might apply. The financial aspect doesn't really apply because for the most part on valuations in the commercial real estate space, 5+ units, they look at the income to value the property, but a 4-unit, 2-unit property, that's more like comps. But if you're buying a property for an investment and you still want to make sure that those tenants are paying rent, right? So it's kind of like you kind of want to pick and choose which ones that would apply for a smaller property. But for the purposes of the due diligence process, this is more so like larger acquisitions. But some of the things still apply though.
Perfect.
All right. Do we have any other questions about the due diligence process?
This is India again. I have a quick
Yeah.
question. I know the due diligence process, of course, from just knowing it, being in the space that you're in. What are
Yeah.
you going to have a class about putting the package together after you finish the due diligence process for you, for far as you as the developer or the investor or whatever, and then you
Yeah.
put the package together and you want to raise capital to purchase to buy these multi-unit developments that are over a certain amount of units?
Yeah, we could certainly add that to the list of webinars that we could talk about. That's something that's definitely crucial because obviously you're pitching the deal to your investors, and I don't really like to say pitching because I'm providing an opportunity. I'm providing an opportunity for you to put your money in an asset that's going to produce cash flow and is an inflation hedge. But you definitely want to have a nice package together that makes sense. And I think speaking to your investors is another thing as well, right? So, if your investor is not super savvy, you don't really want to throw out sophisticated terms like IRR and
Right.
a yield on cost and a lot of those sophisticated metrics that institutional maybe investors might throw out. You might want to throw out like more softer, terms like a cash on cash, right? That's something that anybody for the most part that understands basic finance might understand a cash on cash return, right? So I think really speaking to your investor is something that you want to think about when putting that together, because I always like to say a closed mind says no. So I try to keep things as simple as possible for the most part. But then when I'm having conversations with people on a one-on-one basis, then I know I can talk their language. So
Right.
I try to keep it simple, but I try to make those conversations as appropriate as needed.
Thank you.
All right. Any other questions that we might have for the due diligence process? I don't think that I put the link in the chat here, which I am doing that right now for the
What type of diligence do you do on like the HVAC systems?
You said what type of buildings do we do for HVAC?
No, I'm saying what type of diligence do you do? Do you do like a physical count during that time? Like what other is there any like diligence related to the HVAC system?
Oh, okay. Oh, diligence. Okay. Sorry.
Mhm.
Sorry. I think as far as diligence, I kind of have a construction background from just, single family stuff when I first started doing this, maybe
Mhm.
about 5 years ago. I just really look for the age of the HVAC. I think that's the biggest thing. And you can kind of tell just by eyeballing from a physical perspective, like, which HVACs look newer and which ones look older. I know a lot of times the biggest issues with HVACs is just because people don't change the filters. And I think, from a diligence perspective, you definitely want to have, some sort of buffer in your CapEx budget for those HVACs. But from a diligence perspective, when we take pictures, we just take a picture of it. And, if we feel like, a lot of those HVACs need to be replaced, then we'll definitely have a placeholder in our renovation budget for that. Because as you probably already know, HVACs, just a system, depending on how large it is, 3,500, 4,000, depending on how large it is, right? And what market that you're in as well. So from a diligence perspective, that's what we do with HVACs. It's just we just try to eyeball and figure out, and also ask the seller, have you guys replaced any HVACs recently? And that comes down to, like, with the mom and pop ones, they don't really have like a CapEx schedule. So the larger institutional or private equity firms, that have professional property management, they have a CapEx schedule that they can tell you which units did what. And just by going off of that, you can kind of take that to your underwriting and pencil out exactly what needs to be done as well. So.
Got it.
All right, maybe we have one more question that we can discuss. Anything regarding to due diligence. Appreciate everyone's time. I'm really excited to talk about this, because this can definitely make or break within the especially the mom and pop ones. Definitely don't look past the financials with mom and pops, because it can be crazy when you acquire a property and the income isn't coming in as expeditiously as you thought it would. So. Any last question about anything?
So do you typically leverage what you're seeing in the due diligence for like as an opportunity to retrade the deal, or?
Absolutely.
Yeah.
The example I gave with the aluminum wiring situation, we took that to the seller and got like a $20,000 credit, and then found out we sent our electrician, and we he told us that it doesn't have aluminum wiring, and we got that $20,000 credit up front. So we were pretty excited about that. Our inspector noted the aluminum wiring in the inspection report, so we just took that as face value. But when we actually sent an electrician to the units to upgrade the systems, the electrical systems, he told us that it wasn't there were not any aluminum wiring there. So we got a free 20,000. So definitely, just like anything in real estate, you want to beat up your seller if you can, but then you also want to kind of manage that relationship with the broker, because you don't want to be that guy or that woman that has that reputation for wanting to retrade a deal. That's something that you don't want. So you really just, a lot of times we want to go back to the seller if it's something that we know has materially impact our underwriting.
And then are you walking the properties with your property management company that you're planning to hire for that property? Or do you guys already have it vertically integrated?
Yeah, not necessarily walking the property with the property manager. Because although I think there's benefits to that, if they're available, then yeah, but for what we've done, we haven't used a property manager, just because we feel comfortable with the physical aspect of the property. The part that we really bring in the property manager is for the rents and the operating expenses, right? So if we're looking at, like, we got this 166 unit deal that we're working through right now. It's not on the contract yet, but when we get to a stage where we're in due diligence, we need to figure out like things like payroll, for example, right? You need to know exactly like how much your property manager thinks that you can find a nice solid property management for, at what rate too, So little things like that is what we rely on the property management for, to sharpen our expenses.
Got it. Oh, and just my last question, what about taxes?
Yeah. So taxes is very, very crucial. So like
Yeah.
I think
Yeah.
it varies by state. That's something that's really, really important and likely is the biggest budget within your operating expenses. Um, and so a lot of times with some tax areas like Richmond, for example, they reassess every year, right? Those taxes
Oh, wow.
reassess every year versus
Wow.
Baltimore City, we have every 3 years, and so it's phased in. So we like to call specifically maybe within the financial due diligence period, we like to call the tax assessor and ask them, hey, what's the tax rate for this particular asset? Is it going to be reassessed next year? Where do you think is going to be reassessed at? What value, if we buy it at 10 million, do you think is going to be reassessed at? So that's a part of the financial analysis and feasibility, because if your taxes are going to go up incrementally, that's going to impact your cash flow. Case in point, we were looking at a historical tax credit property that was phasing out into the next 2 to 3 years into the regular at market tax standard. And if the deal didn't work under a loan assumption, then it just wasn't going to work at all, because just the way that the rates are today, the interest rates are today, we needed some time to take that value add property from where it is today versus where it's going to be in the next 2 to 3 years, increasing those rents so we can take on the taxes and still get the returns to our investors. So definitely little things like that, looking at things from all aspects, is something you want to do when taking a look at those properties.
Got it. Yeah, that's helpful.
Sounds great. Well, thanks everyone for taking the time to talk about due diligence. When I do these webinars, I always like to pour into it and give people the opportunity to learn something and then take actionable items so they can go out and do their own deals or do whatever that they want to do in real estate. So thanks a lot for joining me today and joining us today on the due diligence process. And so I put the checklist into the chat, and we'll be sending that out along with the recording as well for the folks who were unable to make it today. But thanks again for tuning in. And so, we plan to have another one next week. So looking forward to seeing some familiar faces.